2022 has been very volatile. We have seen Russia-Ukraine happening. Along with that, inflation was at multi-decade high in many of these global economies. But on the positive side, if we say SIP numbers were at record high, we see index and the Indian markets touching record high levels. During this volatile time, going forward in 2023, I think we are stepping with a bag full of uncertainties. But how should one create a a volatility-proof portfolio? What will be your advice on that?
Srishti, there's a lot of things which need to be deciphered when it comes to volatility. Unfortunately, when we speak of risks and volatility, it generally ends up remaining an English word. But I think it's important to measure volatility and then see whether it was high, low, or medium. Now, for example, India's volatility for the last 1 year has been the least in the globe. Okay, S&P 500, which is the largest index or at least covers the most broadest US companies, has shown a larger volatility than India has. This year, from a standard deviation perspective, which is what volatility is measured in largely statistically, has been an average of 16, whereas S&P 500's volatility has been 22. So we have been fortunate, point one, as an Indian capital market to have lesser volatility numerically. Perceptions could be different, but numerically it's lower volatility, point one. Point two, of course, we have seen highs and lows several times here. This year, we've seen 18,000 twice. We've seen 15,200. We've seen 15,700. Market has done that seesawing as well. So if you have to make it a volatility neutral or low volatility portfolio, we have to have several elements which we need to take care of. First is the asset allocation. When you want to have a lower volatility, you have to define two things very, very importantly. What are you ready to lose? And in what period do you want to not lose? For example, if you told me, Feroze, what is your measure? I would look at risk on a 3-year basis, not on a daily basis. Because today, if I buy something, tomorrow it could be lower. I have to protect as the owner of the money that 3 years later, I should not be in the red from my capital standpoint. If that's the number which resonates with the viewer, he needs to first define 3 years as his capital protection period. And he does not want to lose, he doesn't mind losing the return. So I don't mind losing the return, but never lose the capital. So if this is my definition of the risk I am ready to take, even a 50% in equity and a 50% in debt, under all circumstances will protect you. Okay, because the worst 3-year Nifty return has been 22%. So even if that happens, if my 50 rupees in equity depletes by 20%, which is now it turns out to be 40 rupees, my debt of 50 rupees grows to 65 rupees. So as a total, I'm still at 105. That's how you protect your portfolio. So define the time period in which you wish to protect. Are you okay to not make money under the worst circumstance? That's my definition to the risk as an investor I'm ready to take. If that's the definition, then a 50-50. If you're ready to take a little more risk, I would suggest where we are as a country, if you have 70% in equity and 30% in debt out of your total financial assets, you would still be very safe. That's point one. Point two, don't just stick to large cap. Sometimes large caps perform, sometimes mid caps perform, sometimes small caps perform. And that's what happened in the first 6 months. Mid caps and small caps performed. The second 6 months has not been hunky-dory for the other two, mid cap and small cap. So have diversification across different sizes of companies. So at today's stage, I would say small cap could be on equal par with risk with mid cap after all the froth being washed away. So on and so forth, Trishti.
Okay, thank you so much, Feroze, for helping our viewers understand what could be their likely portfolio allocation for 2023, and in that as well, if you're choosing for a equity side of it, between large cap, mid cap and small cap, what you should be looking out for. But Feroze, I want to understand the roll down approach for the debt exposure. How do you track that, and what is your sense on this particular, because you did touch upon the debt side of the business, but in that, what should be one strategy?
Yes, Trishti, very rightly, because if you got your asset allocation right, You got your equity allocation across different sizes of companies. Then you move to the 50 rupees in debt, for example, or 30 rupees in debt. You need to have a low cost, interest rate neutral strategy. What do I mean by that is the volatility induced because of interest rate movement should also be eliminated from the portfolio, and that's what a roll down strategy does. As the name suggests, roll down implies that you buy a bond, the fund manager buys a bond and holds it till it rolls down to maturity. These are also called target maturity funds. If held till maturity, the interest rate risk, which is another risk on the debt side, gets eliminated, helps you contribute to that lower volatility aspiration when you create the portfolio. For example, today if you buy a 3-year target maturity fund, which only invests in government of India, central government paper, you're still able to make 6.5% after tax. So if that is your kind of return which is possible, do you want to take interest rate risk and credit risk? Definitely not for a person who is worried of risk. So a roll down strategy or a target maturity fund of central government paper, which gives you the tax arbitrage or tax benefit, is the greatest low cost strategy on the debt portion. Very simple, just lend to government of India and hold it till maturity, and your interest rate risk disappears, your credit risk disappears, not just the equity market risk coming down.
Talking of the international exposure, because after COVID, the kind of returns that we were seeing in the global equities, not just in India, even in the US markets, a lot of investors actually entered in this space as well from India. What is your sense going forward in 2023? A right time after so much of correction from the highs of even both of the three index of US markets going forward in 2023, will that be a good bet?
Srishti, see, to my mind, sometimes an optical diversification induces risk in the portfolio, then reduces risk. We checked the correlation between Indian capital markets and the US capital markets, the three indices which you mentioned, which is, of course, S&P, Dow Jones, and NASDAQ, have shown more volatility, and they are related to equities of India as well. They're not isolated. So when people believe that they're sending their money abroad and they're reducing risk, may not be the case all the time, because they are two sides of the same coin, equities. So point one I'm making is, of course, US has corrected and we've had a 15-20% outperformance in the calendar year 2022. This is definitely a good time to add, only for those guys who have global aspirations. What do I mean by that is, if your goals are hinging around dollars, for example, your child's education abroad, a global tour, then definitely international funds are a great mechanism to accumulate dollar exposure and hedge yourself against the currency depreciation, which is near certainty. Every year, depreciation of rupee of 3-4% is what will happen because of the higher interest rate economy we live in. So to answer your pointed question, no compelling need to have international equities. I, in my current portfolio, have zero international equity, and proudly so, because if the Indian economy is growing at nominal rate of 12-13%, finding businesses here which can grow at 20% is a lot easier if the economy is slipping into a recession. And if my analysis is right, I would guess that there's a 60-70% probability that US will slip into recession and India will not be at a damage, but will have a collateral benefit of that.
By NC, but that brings me to the last question that we have for you, Feroze, that is volatility here to stay? What is your long-term and the short-term view for 2023 for markets and returns expectations?
Yes, Shrishti, volatility is here to stay. Any asset which can give you 3 times the return of a fixed deposit is not going to be a smooth linear curve. The expectation of it being a straight line is unfair, because why do I, as an investor, deserve 3 times more than a fixed deposit if I'm not even able to take the volatility of a year, 2 year, 3 year? So point one, volatility is here to stay. But now if you look at data for the last 20 years, Indian volatility, which is measured in standard deviation, has reduced dramatically. The realized volatility of Nifty in 2008, for example, was 52. Today it is 14, 15, 16. So volatility has reduced considerably. That's point two. Point three, and every equity investor needs to remind himself or herself before they enter that every year Nifty has corrected 14.3% from peak to trough. It is the habit or the nature of this animal. 14.3% every single year, removing the two exaggerated years of 2008, 2020. If I remove them, the average fall from peak to trough is 14.3. If this is something which surprises you after investing, that means you've not looked at data enough before investing. So always remind yourself this data and then cut a check to equity. Then is when you will be able to make money. Otherwise, those monies are always going to remain in the charts for you to see, not in your bank accounts. So I think volatility has reduced. Will it stay? The answer is yes. Will it become a more mature market? The answer is yes. Please accept that and embrace volatility and enjoy that 2, 3, 4 times the return equities have the potential to deliver.